Here's the thing. While the U.S. may not have seen a surge yet in Delta variant cases, there are countries like South Korea, Japan, Israel, right, looking at these different restrictions and lockdown, attempts to lock down if needed. How are you approaching this potential risk as an investor? Your thoughts there?
Yeah, it's certainly a risk that we have to be aware of in the second half of the year, especially as we get into the fall, as more and more people are going to return to their offices. People are going to be gathering much more inside at that point in time. So it's something that we will keep in the back of our minds. But the reality is we're at over 50% vaccinated here in this country, at least with one dose. And what we are hearing from experts like Scott Gottlieb that come on your network all the time is that there will be portions of the country that will be more significantly impacted by this, but we're not expecting to see as big of an impact as we did last fall when we got the surge last year. So from an investing perspective, we're really keeping a focus on earnings. And that's what it's going to be all about over the next several months as we expect the reopening to continue to accelerate. And I don't think that that's quite priced into a lot of the earnings numbers for many of the sectors and stocks out there right now.
That's interesting. So you wouldn't use the stocks that worked last year as a guiding principle and say, you know, if this Delta variant is becoming a bigger risk over time here in the U.S., let's add exposure to some of those stay-at-home names, maybe pull back on the reopening trades that have actually had a pretty good run up already this year, Lindsey.
Yeah, that's certainly one way you can play it. But I do think that a lot of the reopening trade names that have started to take a pause could see a little bit more life over the next couple months as these numbers come in better. The consumer is in a very strong position going into the second half of the year. We still have a very high savings rate at 12.4%. We've got $17 trillion in cash deposits at banks right now. And we saw the consumer confidence number come out this week very strong. And within the details of that, you heard from consumers saying that they're still willing to spend on high ticket items. And they're actually planning to do that, like automobiles, homes, appliances. They're even planning more vacations. So their intentions to spend are still high as we go into the second half of the year. So that's what it keeps me optimistic about what sales and earnings can look like in the second half of the year.
And you talked about the stronger consumer spending that we are seeing in recent weeks. And now the question is this jobs report and whether that will be reflected in the unemployment rate. What are you expecting and how are you trading it in this jobs report?
Yeah, this is going to be an important report because over the last couple months, what we have seen is moderation in jobs added, and to that has been actually a positive for the market because the Fed is keenly focused on this jobs number as we move forward because it's really dictating monetary policy. And so if this number were to come in much hotter than what the expectations are, that could maybe make the market a little bit nervous, assuming that the Fed's going to move sooner rather than later. If it comes in a little cooler than expected, it may be seen as a positive for the market. So it's definitely a number that we definitely have to watch today. As like I said, it's going to dictate monetary policy going forward. And as we know, the market is very antsy and nervous around when it comes to monetary policy because the Fed in the past, as they begin to start tightening and normalizing interest rates, it can ultimately lead to a peak in the market. However, I would note that that doesn't typically happen at the beginning of a rate tightening cycle.
Shepard Smith here. Thanks for watching CNBC on YouTube.